Welcome back. We are now in segment 6.10, and in this segment we'll be discussing about current liabilities. So far we have discussed about term liabilities. So under term liabilities we have discussed various items such as term loans from banks. We had share application money, unsecured loans, and various other term liabilities. Okay. Though share application money can also be clubbed with capital. That's an advanced topic, but really there are various term liabilities that we have considered. Now we'll move on to current liabilities, and in a balance sheet you can possibly come across variety of current liabilities. And if you are comfortable with this following current liabilities, that should be more than enough in doing a proper job at the appraisal, right? So these are the popular current liabilities items you will come across in balance sheets. Short-term borrowings from banks. This is actually the OCC, SOD, the short-term funds, like including PC. Short-term borrowings from others, WCTL, creditors, advance payments from customers, provision for taxation, dividend payable, statutory liabilities, installments of term loans due within 1 year, deposits, advance from suppliers, interest and other charges accrued but not due, mobilization advances and provisions. So in this segment we'll be discussing about each of these items, right? So the most important current liability from the perspective of bankers is short-term borrowings from banks. Okay, these are your working capital limits such as OCC, SOD, PC and other short-term funds. The purpose of these funds is for meeting working capital requirement. Okay, so earlier when we discussed about term liabilities, we had a facility called term loan from banks. Okay, and we are going to see in the chapter on term loan appraisal, right, what are the features of term loans, and one of the features is the repayment period is more than 1 year, right? The loan is not due for repayment within the next 1 year. Well, whereas these facilities are due for payment within the next 1 year. Though in actual practice these facilities gets renewed and they get rolled over, but we'll see shortly the reason why they are classified as current liabilities. But for the moment, understand the working capital limits such as OCC, SOD, PC are short-term borrowings from banks. If current liability, we have discussed what are current liabilities, right? Current liability is something that is due for payment within the next 1 year. But in practice, you're aware as a banker that in sanction of working capital, when you go for renewal of working capital limits are due for renewal every 1 year and they get renewed, right? You're not asking the party to repay the working capital outstanding. So say for example, today is 31st March 2015, okay, and the outstanding OCC, right, is 410 lakhs. Now this company is availing a working capital limit of 450 lakhs and this has come for renewal of working capital limit. What you're going to do as a banker is you're going to renew this limit for the next 1 year, right? So till 2016, March 2016, this limit gets renewed. What it means, the company can continue to operate the account for the next 1 year. The question of repayment doesn't arise. So if the question of repayment doesn't arise, why are we treating it as current liability and not term liability? So there is a school of thought that the short-term borrowings from banks, these short-term credit facilities, need to be classified as term liability because they're not getting repaid. They're getting rolled over year after year. So the point you need to understand here is technically they are repayable on demand. That is the first point, right? Technically they are repayable on demand. The second reason is the purpose of the short-term funds is to finance short-term assets, right? Like goes with like. Whenever you do a comparison, you have to do a meaningful comparison. Current liabilities finance current assets. Term liabilities finance long-term assets, that's the fixed assets. Okay, this goes hand in hand, current liabilities and current assets. So even though this facility gets renewed, rolled over every year after year, the purpose of current liabilities is to finance current assets such as your inventory, which includes raw material, stock in progress, finished goods, and also debtors. Okay, so when this is a current asset, the purpose for which these funds are used is a current item. It makes sense for this fund to be also, for this item to also be current liability. Just because it's getting renewed and rolled over doesn't mean it's a term liability. So always make it a point that short-term borrowing funds are current liabilities. Don't ever classify them as term liabilities. And in this context, you need to be aware of something called bills discounted. Bills discounted, sometimes companies do show them as contingent liabilities. Now, as a banker, when it comes to assessment of working capital limits and CMA classification, you have to classify these bills discounted as current liability. And what you have to do, you have to show this amount under the liability side, because this figure you'll be getting in from the, because this figure is available from the contingent liabilities usually, or given as a note somewhere. Take that figure, put it in the liability side and current liability, add it to the bank borrowing on the liability side, and equivalent amount you add it to the receivables on the asset side. This is one modification you need to do when you come across an item called bills discounted. Okay. Then there are some other items called short-term borrowings from others. These are not banks. Okay. Banks have facilities such as CC, OD and other facilities. These are short-term borrowings from parties other than banks. So what are these facilities? Commercial paper, bridge loan, right? So what is commercial paper? Commercial paper usually will not come across that frequently, because this is usually given for very large borrowers. There are some criteria. Not every company can raise commercial paper. This is a short-term debt instrument raised by companies which have a very high credit rating for meeting short-term liabilities. This is not backed by any collateral, right? And that's why I said these are raised only by firms with very high quality debt ratings, and they are very strict RBI guidelines, such as there should be some minimum net worth, right, or rating, and you will not normally come across this facility. But anyway, a brief discussion of this is provided in the chapter on credit concepts. We'll see more about this later. But if ever you come across an item called commercial paper, you have to classify it under current liability. Then there is another facility called bridge loan. So bridge loan is a short-term finance. Okay, it's a you can, as the name implies, it's a bridge. You know, between a temporary and a permanent source of finance. So take for example IPO. You know, when companies approach the public for raising capital, you know, in the primary market, this is the initial public offer. It takes time. You know, IPO is not something that is done overnight. Okay, it takes some months. But say for example the company is in urgent need of fund, right? And say this process takes 6 months IPO. The company can't wait till 6 months to have the funds. What it can do is it can avail bridge finance, and continue the work, whatever the project work it wants to do. And after the IPO funds come in, the bridge finance can be closed by the proceeds of this IPO funds. Again, it's not a item you're going to very regularly come across. Okay, but if ever you are going to come across, please classify it as a current liability. The advantage of bridge finance is it provides immediate cash flow. Okay, it provides immediate cash flow. But again, this is available only for very large parties. You're not going to encounter both these items very frequently, but they are classified as current liabilities, basically because they are in the repayment is then 1 year, and that's why I classify them as current liabilities. Then we can have a facility called working capital term loan. Also a facility for meeting working capital requirement, but, including shortfall in margin money for working capital. So where we actually come across these sort of facilities is when the company is availing, say, a CC limit, and the outstanding, right, the CC actual outstanding is not backed by DP. Usually in those sort of situations you see WCTL, right? So what banks do is they convert that irregular portion. Say for example the outstanding is 200 lakhs. This is the outstanding, and say the DP is only 150. Right? We'll see what DP is, right, when we come to it. But for the moment, understand that banks restrict the drawing in CC account to lower of the limit in DP, right, whichever is lower. So if the DP is 150, the irregular portion is 50 lakhs. So banks convert this 50 into WCTL, and the WCTL is a term liability. It's not a short-term liability because it gets repaid in time is given to repay it in, say, 3 years. Okay, so it becomes a term liability. WCT is usually a facility for companies that are not doing very well, especially on the CC front, right? So that the working capital, a portion of working capital is converted into term loan. Hence the name working capital term loan. Okay, right? This is not a term loan in the traditional sense where you used to buy long-term assets like land building. No, it's not that sort of facility. It is used to clear up your accounts payable, wages, and those sort of items. Okay, WCTL is actually a term loan, right? But it is classified sometimes as a current liability. But the purpose of WCTL, the concept of WCTL, is to convert the irregular portion of term loan of working capital into term loan. So this is actually the correct classification is a term loan. If your bank classifies it as a current liabilities, you need to follow this guideline as per your bank's policy, right? There is no right or wrong answer. If you ask me, I would say WCTL is more a term liability. I mean, that is basically the concept, right? You convert a portion of working capital into term loan to be repaid, say, in a period of 3 to 5 years. Okay, so this is actually a term loan, but in case your banks do classify it as a current liability, please go ahead with your loan policy guidelines. Please check with your bank policy what is the correct classification. Okay. Then a very important item under current liabilities is sundry creditors. So when we discussed about liability, when we started a discussion on liability, I defined liability as a source of fund, right? So when bank extends term loan, it is a source of fund, hence it's a liability because bank is giving cash. I mean, not literally cash, but it's allowing the company to draw from an account. So your OCC and all these are funds. These are physical funds given to the company. Creditors do not give you funds, right? So creditor is a say for example, there is a raw material supplier. The company has purchased raw material from this company, and this company has given, say, a time of 30 days to repay the amount, right? So the company has got the material. It has started working on the material, processing, production is going on. Maybe it's turned into finished goods, but still it's not made the payment. After 30 days, it will make the payment. Okay. So did the raw material supplier give any funds? No, he did not give. The raw material supplier has not given any fund to the company. So you might think it is strange to be classified as for creditors to be classified as a liability, right? But you have to just modify the definition a bit. It's not just source of fund. Liability is also any item where the goods or service has been provided, but payment is not made, right? So the goods or service has been provided, but the payment is not made. That is also liability. What is liability in traditional sense? I mean, liability is something you owe money to somebody, right? So the company owes payment to the raw material supplier, hence it's a liability. Creditors, there will be a small distinction between trade creditors and creditors for expenses, right? So both are creditors, both are people to whom the company owes payment, but these are raw material suppliers. So a distinction is made because these are a very huge component usually in a liabilities front. So a distinction is made between creditors of raw material suppliers and normal creditors. So these are creditors for expenses. Okay. So the company can be having pending payments to be made to some other miscellaneous suppliers. Okay. So those are different. Raw material suppliers, the key creditors, they classified as trade creditors. Okay. So all your salaries, wages, rent, they will come under any pending payments. You can classify as creditors for expenses. Then there is something called creditors for capital goods. Now this is a tricky classification. Creditors for capital goods is sometimes just like raw material suppliers give company time to pay, say 30 or 45 days, right, depending on the industry norm. The machinery suppliers can also give time because if you think about it, the machinery, the cost of machinery is huge. Sometimes runs into crores. So the machinery supplier cannot insist on payment at once. For a sound business, it's practical to give credit to the buyer. So credit payment is common in every aspect of business, either raw material or machinery. More so in machinery because the payment is huge. Now these creditors are known as creditors for capital goods, right? Creditors for capital goods. Machinery is a capital good. Now this is distinct from your trade creditors, right? Raw material suppliers. When it comes to classification of these creditors for capital goods, some banks classified as a term liability, some classified as a current liability. The banks who classified as classify this as a current liability base their logic on the fact that the payment is to be made within 1 year. Usually the machinery supplier will not give time more than 1 year, so hence they treat it as a current liability. The banks which treat creditors for capital goods as term liabilities go by the logic that this is financing a long-term asset like fixed assets, right? So they say it is more appropriate to classify it as a term liability because it is financing a long-term asset. Current liabilities finance current assets like your inventory and debtors. Term liabilities finance the long-term assets. So some banks classify as a current liability, some as a term liability. So again you have to refer back to your bank's policy guidelines. Usually this is more common, creditors for capital goods being classified as a term liability, but there are banks who classify also a current liability, right? So therefore it comes down to your bank's classification. So just check it up. Okay. Now if this item is classified as a current liability and still the current ratio is greater than that minimum of 1.33, that's fine. There's no problem. So either you put it in a term liability or current liability, right? It doesn't matter. But if you put it, if we classify it as a term liability, creditor for capital good as term liability, then the current ratio is greater than 1.33. But if the classification is changed to current liability and it drops below 1.33, that might be a problem, right? So just check up with your loan policy guideline to see the correct classification. Now sometimes companies pay advance to raw material suppliers. It happens. So you will see in the balance sheet on the liability side, there will be some creditors. These are the payments the company is due to make to the raw material suppliers. So the goods have been received but the payment is not made. Say this is 10 lakhs. On the asset side, you'll be having advance payment to the same suppliers, the material suppliers. So this, say for example, is 5 lakhs. So this item you can either show it on the asset side or you can net it off with the creditor. So instead of showing 10 and 5, you can show here 5 as a single figure. You do the netting and show as a single figure, or you can show it separately. Either one is fine. Okay. Then there is another liability, that is advance payment from customers. What is advance payment from customers? If you think about it, right? So say for example, you're purchasing a flat, right? You give an advance to the builder. Okay, you give advance to the builder. Has he handed over the building to you? No, but still you're paying him advance. So that is advance payment, right? Even before you receive the good or service, you are paying some amount, that is known as advance. So this is a liability. So from a company point of view, if there is a customer, say for example, you're a very reputed company, a lot of orders coming in, and right, you're not able to service each and every of this customer. You have limited stock. Say for example, your stock only 50, whereas 100 to 200 people are chasing you. What do? You say you pay advance. Whoever pays advance, I'll give priority. Okay. So when you take the advance, the money is coming first. You have not delivered the goods. So you owe so in a way you owe the product or service to the customer, right? You have to give the product to him one day. So it's a liability. So in that sense, advance payment from customers is a liability. The business logic for advance payment is very sound. Why do companies insist it? Say for example, if there are a lot of custom made machineries, okay. Say for example, there's a huge machinery costing 10 crores. This is made only for the particular order. There is a company which has ordered a particular machinery. Say for example, from a BHEL. This is a heavy vessel, right, made specifically to the requirement of the company. Say it's a huge order of 10 crores. Okay. Now if the supplier starts making the machine, but midway the company cancels the order, is a loss to the machine, the vendor. Okay, because this is exclusive for this company. No other, there'll be no other buyer. So to avoid those sort of problems and to have a firm commitment from the company, right, companies insist on advance payment. So it is quite logical to think about it, why companies insist on advance payment. But whenever they receive that payment, they owe something to the customer. They have to they owe the product or service to the customer. So it is a current liability. Why current liability? Because it is to be delivered within 2 to 3 months or maximum less than 1 year. Hence it is a current liability. Now this item is also known as income received in advance. Both mean one and the same. Then if you ever come across an item called customer deposits, it's also treated similarly as advance payment from customers and classified as current liabilities. Then there is another item called unaccrued income. So unaccrued income is income that is received in the current accounting period, but which is actually due only in the next period. Right, so obviously this is like income received in advance. Okay, so this is also a current liability. So basically, any advance payments from customers you will classify it as a current liability when you come across in the balance sheet of a company. Then the next item is provision for taxation. We have discussed about this item in the P&L account. It might be a bit advanced topic. I have told that earlier at that stage itself. So refer back to the section. If you find it comfortable, you can go through that entire section, or if you're not comfortable, no problem. Whenever you see provision for taxation, you can classify it under current liability. Okay, this is a current liability because the tax assessment will be completed in the next year. Now sometimes what happens is the provision for taxation can appear both on the liability side and the asset side. Provision for taxation. So in that cases you can do the netting, and that's allowed. Okay. Then there is an item called dividend payable. Again, not a item you're going to regularly see, but it's not a rare item as well. If it's a big company, right, you will see this item, dividend payable. So what is dividend payable? So based on the profit earned, right, say the financial year has completed, financial year 13-14 is completed. So the board of directors of this company may decide to issue dividend if the performance of the company is good. Okay. So dividend is payout on shares. Okay. Now please understand the dividend is not compulsory. It's decided in the board of directors meeting. If the performance is good, they will declare, or else not. Even if the performance is good, they might decide not to declare dividend because the funds can be employed in the further growth. Okay. So if the company decides to pay dividends, there is a time gap between the announcement of that the board of directors decision and the date when it's actually paid. Right. See, the meeting might happen one day. Now the actual payout might take some 1 or 2 months. Okay. So till that time the company actually makes the payment, this dividend payable will be treated as a current liability because the decision has been made by the company to pay dividend, but it is not yet paid. So hence it is naturally a current liability. So say for example, on March 14th, the board of directors decided to declare a dividend of 10 rupees on 1 lakh shares, 1 lakh outstanding shares. Now this dividend will be paid on June 30th. So there is a time of 2.5 months. Right. So as on the balance sheet date of 31st March, the decision is made on March 14th. So as on the balance sheet date of 31st March 2012, there will be an item called dividend payable, which will be classified as current liability. So if that 1 lakh share, each one will be given a dividend of 10 rupees. So 10 lakhs will be an item by the name dividend payable under the head of current liabilities. Okay, as on this date. Now if you are interested in a bit of accounting, you can go to this para. I don't think so that's that relevant to you, but if you're interested in the accounting part, just listen to this. So how does the balance sheet tally? Right. So if on the liability side there arises an item called dividend payable, right, dividend payable of 10 lakhs. On the asset side, no, balance sheet has to tally. Okay. So on the asset side, which item will increase? Now, there should be an equivalent amount of 10 lakhs for the balance sheet to tally. Okay. So what is that item? Right. So please understand, we are not going to increase any item. There's not going to be any increase in any item. Okay. So what we do, we decrease the retained earnings. So 10 lakhs is shifted from the retained earnings. Retained earnings is also on the liability side. If you recall, capital, reserves and surplus and all these are liabilities items. So 10 lakhs will be shifted from the retained earnings to current liabilities. Until June 30th, it will stay as a current liability. And once dividends are declared and paid, so the dividend payables account will be debited. Okay. A bit of advanced concept. If you're interested in accounting, you can. It makes sense to go through this para. Otherwise, leave it. Now, then there are some liabilities called statutory liabilities. These are payments. These are liabilities. That means payment is due to be made to the government agencies. This include excise duty, service tax, professional tax. Now all these are payments which the company is due to make to the government agencies. It is the statutory liabilities. Okay, and they are current liabilities because they need to be paid in the next year itself. Okay, as on balance sheet date of 31st March 2014, if you have a statutory liabilities of 20 lakhs, it's expected that you clear off this by the next year. It's not like the government agencies will be giving a lot of time to pay them. Yeah, you have to pay it within the next 1 year. In fact, within the next few months. Okay, it's a serious liability. So this is a current liability naturally. Then there is an item, installments of term loan due within 1 year. So if you refer back to the discussion, the installment of term loan that is repayable within the next 1 year is classified as current liability. So if the term loan outstanding, you can split the term loan outstanding into two parts. One, the portion that is repayable, that is due for payment within the next 1 year. Let's say for example, out of the 400 term loan outstanding, say 50 lakhs is due in the next 1 year. So this will be current liability and the balance 350 will be term liability. Okay. So it's not just about term loan installments. Any item, say for example debentures there will be some payment due within the next 1 year. Right. So any item which a portion of which falls due within the next 1 year will be classified as a current liability and the balance will be classified as a term liability. So another item is deposits maturing within 1 year, just as we had term loans. Term loan installments due within the next 1 year. Right. This is also an item we can classify. What is due in the next 1 year, what is due beyond. So some companies can raise deposits from public. Okay, so some of the deposit if is maturing within the next 1 year, you have to classify as a current liability and the balance as term liability. And one more current liability is advance from suppliers. Right, this might seem odd to you. Why would supplier give advance? Right, say for example, if you're a company and you want to purchase raw material, you have to give advance. Right, so So what is this advance from suppliers? But it is done sometimes. Okay, sometimes companies employ very aggressive tactics for increasing sales. Right, this does happens. Okay, say for example the stock market. If this is a listed company, and say the company's quarterly sales, the market expectation is the quarterly sales will be 25 crores, but the company realizes it's going to fall short and it's going to achieve only 23 crores. So what happens if the company doesn't reach the market expectation? The share price will fall. So to during the last days of the quarter, what the company can do is it will push the products to its distributors, right? So if the distributors don't have money to buy, the company may give them loan and complete the sale. Right? These are things that companies do, but in those sort of situations, these item arise. Actually, it will not be shown directly in the balance sheet under the name, but in case you come across such an item, you have to classify as a current liability. Then interest and other charges accrued but not due. What is it? This is accrued but not due. Say for example, you have a fixed deposit in a bank, and every quarter the interest payment is made. Say every quarter, March, June, September, and December. So assume today is March 31st. So today you will receive an interest for the period Jan 12 to March 12. For this period you will receive interest on this day. Now the interest is accrued in June. What does it mean? This is due for payment by the bank, okay? Because the payment is made every quarter. But say for example today is April 30th. April 30th, there is some interest due to you for the period for the month of April. The 1st April to 30th April. For that month the interest is to be paid. But the payment is not at due. Okay, bank will pay only on the month ends, on the quarter ends of March, June, September, and December. So this will be paid in June 30th. So this interest portion, it is accrued, but it's not at due. Right? So those sort of items are known as interest and other charges accrued but not due, and you're going to classify this as a current liability. So if you come across any accrued expense, classified as a current liability. So this could be accrued salaries, right? Accrued salaries or accrued export incentives, you can classify as a current liability. Then one more item you can come across is a mobilization advance. Mobilization advance, usually when a contractor executes a major order, okay, so it's a practice that advance payment is given to him, and it will be adjusted later from the work bills. There will be some RA bills raised. From that they'll be making a cut, okay. And mobilization advance usually they'll be giving against bank guarantees, okay. So in the absence of any additional information, you can treat it as a current liability, right? But because usually this amount is huge, because contracts can run into crores, okay, and usually this will be affecting current ratio. Sometimes banks provide the flexibility based on the policy guidelines. So say they can say 50% of mobilization advance you can treat it as current liability, 50 as term liability. Again, only if your bank provides this. So you have to check your loan policy guidelines, what is the exact treatment of mobilization advance. But if there is no specific information, you have to treat it as a current liability. So a lot of provisions, all these provisions, the most important provision is provision for taxation, which you're going to show it separately. But the remaining provisions you're going to club and show it under a single item called other current liabilities and provisions. So these are the various provisions you can come across. All are short term in nature. Okay, you're going to classify it as a other current liabilities, right? But it's a current liability. Provision for dividend distribution tax, employee benefits, gratuity, leave encashment, valuation loss, warranties, any provision, right? It's a current liability. So the items we have discussed so far on the current liabilities are the major items you will come across on the head of current liabilities. There might be some other items which are not very common. It will complete our coverage on current liabilities comprehensively. Very, very rare items. The items we have discussed till now are more common. So there will be some balance sheets where you might come across these items. Acceptances, right? Acceptances can be clubbed with creditors. Right? It is a trade payable. Right? It is a bill of exchange for the amount of purchase drawn by the seller on the purchaser. An application call money received due for refund. Right? This means the issue was oversubscribed. Okay, so the company has applied for shares, but he could not be allotted shares. This happens, right? If a IPO is issued, is oversubscribed 10 times. So there are many people who applied for shares but didn't get the shares, right? So they'll be refunded the application money. So those sort of items will be a current liability. Billing in excess of revenue. This is advance from customers, which we already discussed. This is a current liability. Deferred revenue. This is the revenue received in advance, right? Or if you speak from the income recognition point of view, this is income recognized in advance. This is usually a long-term liability, but companies also furnish the breakup, how much is current and how much is term liability. Again, a rare item, but the portion which is classified as current liability, you have to show it on the current liability. Derivative financial instrument liability, advanced topic, it's a current liability. Foreign currency loan, if the classification is provided, you can treat it as a current liability. Hybrid perpetual security, again a rare item, usually in very big companies, right? So these are perpetual in nature. Perpetual means there is no maturity, no maturity or redemption. Okay, these are callable only on the at the option of the company. It's not a debt, and some classified under equity, right? But to be on safe side, we can classify it as a term liability. And salary, bonus payable, outstanding expenses, all the current liabilities, because these payments have to be made within 1 month. Okay, because salary payment is a monthly payment. Then sales tax deferred liability, to encourage units to be established in some remote areas. What do government sometimes do is they provide deferment of sales tax. Right, it has to be paid. It's not waived, but sometime later, say after 5 years or 10 years. So that will be a term liability. But the portion of which is falling due the next year has to be classified as a current liability. Then unclaimed dividend, those sort of items, these are current liabilities. The claim is there, but nobody has claimed it. We don't know when they're going to come back. So to be on the safe side, classified as a current liability. Again, unpaid dividends, company has to pay them, but not yet paid. So it's a current liability. So these are some other items you can come across under the liability side. So with this, we come to the end of the segment. In this segment, we have discussed various items that you can possibly come across under the current liabilities. In the next segment, we'll be having a short quiz, right?